quick chronological history of where we started and where we are today. So in '87, Nick incorporated the company in Tampa. 2003, we moved to Sun City. By the way, each of these events were huge for us. So it's all on one page, but I'm looking at it, and that's most of my life right there today. We moved to Sun City in 2003 and purchased another CPA firm, satellite office. That was a pretty big move for us. 2007, we merged with a top 100 company accounting firm called Cohn & Company. We changed our name to Cohn, Florida at that time. The next year, we purchased a firm in Sarasota. The next year, we purchased a large firm in Orlando. And then a couple years later, we said, to heck with this, and we went back to Lanese Associates. And now we have two offices, Sun City Center and Sarasota. Thus, the name changed back to Lanese Associates. You're looking at the two bosses. Where is Nick and I? We have 16 employees, 6 CPAs, and Nick and I are the only 2 equity partners. We do have another partner who's a non-equity partner. We're hoping he's going to buy it sometime soon. So 25 years of experience in this business, been around a little bit. Next slide, please. Even though our primary service is taxes, we are really good at taxes. Tax preparation, tax planning. I'm not even going to talk about taxes today. I'm going to talk about 2 other areas that make our clients happier than taxes, and that's cost segregation studies and BP oil claims. Okay, Randy. Okay, cost segregation studies. I've talked about this before. Confuses a lot of people, and this first sentence is probably going to confuse more people. What is a cost segregation study? It's an engineering-based analysis to properly classify assets into depreciable categories. What the heck is that? Very simple. A building like this typically is depreciated over 39 years. That means you get 1/39th of that building on your tax return as a deduction. Cost segregation study analyzes the building and breaks it up into parts so you can more quickly depreciate it. So the next point there are 4 basic asset classes. Land, which can't be depreciated. Real property, which if a rental is 27.5 years, if it's just being used by, like our building is being used by us, depreciated over 39 years. That's just a little bit of depreciation a year. Land improvements, 15. That's like the parking lot, pavers, landscaping. Tangible personal property, desks, computers, anything inside is really quick depreciation, 5 to 7 years, and with 179 years. A lot of times you could deduct it all in the first year of purchase. So what the cost segregation study does is get inside this building, rip it apart, and break it up into parts that may be able to depreciate quicker than if you just put it on the books at 39 years. It could have a dramatic effect on deductions, thus gets you taxes back. Next slide, please, Randy.